Thanks everybody for having me. It's a pleasure to be here. My name is Brett Cooper and I am the Head of Commodities for Asia at INTL FCStone. We have 20 minutes today, so I don't want to labour on too many points, particularly just from an introductory perspective. So here's a brief overview of our firm. Many of you will have, hopefully will have met, and a number of you hopefully would have at least have heard of our firm. So as I said, it's a pleasure to be here, and hopefully there's some useful insight out of this presentation. I've been asked to present on what are the practical applications of risk management in ag. And so to do so, I thought it would be interesting to start with these couple of images, because what I find interesting about this is that it's a great way to illustrate the topic, but also illustrate what I'm trying to provide for you as far as some insights. The first picture here is clearly a couple of guys dealing with the hot potato. And in this context, the hot potato happens to be risk and it happens to be price risk. So like it or not, everybody in this industry is already playing that game. The market is spending all of its time pushing and pulling that risk up and down the supply chain. So the potato is being thrown around. So risk management ultimately gives businesses and yourself, if you have the tools available, to decide what you want to do with the potato. Not all risk is bad, but every business has a pain threshold, with profitability being an obvious one. So businesses should be at least equipped to make these choices and not have the market decide for them whether or not they're stuck holding that potato. The second guy I think is equally interesting, and I think is the point of today's presentation, because it looks to me like, if nothing else, he has a plan. So what we have here is representative of the guy's plan. And so I think it's important that in order to manage risk as a business, and in order for us to sort of introduce the concept to you, it requires a framework. And I think this is, albeit tongue-in-cheek, at least is representative of the type of framework which can work in a practical sense. So if we go through what each of these points mean, to identify in this context is really, we're talking about what are the components of price and what are the items and the things that influence price, and what can be managed. Secondly, the target acquisition, which in your business is what are the objectives, where is the risk, and what's your tolerance. The third thing, what I've referred to as to weaponize, is really, which is probably obviously, making sure that your business has the tools available to deal with both of these. And then clearly we need to have a plan in terms of how we're going to deploy those tools to achieve our objective. And finally, there's the execution phase. I guess the only missing point in this is the fact that this should never be a static process. So I think it's a process which is enveloped by the need for constant review and renewal. But again, I think this, at the very least, provides a useful framework for anybody to follow, particularly those who are starting out in this process. So this is a simple illustration, which many of you will have already seen. And this is really looking at price and refreshing ourselves in terms of what are the components of price. In the context of risk management, we look at having two key components, and that being basis and futures. And if we add them up, we're going to refer to that total price as flat price. So basis and futures are quite interesting beasts in that they obviously are influenced by very different factors and can also behave independently of each other. But to manage risk, we need to understand what are the factors and the types of factors that can influence each of these, because understanding that will go a long way to helping you to understand how this will affect your business. And we need to learn what we can do to eliminate or manage the risks. So what we have here is a chart representative of Chicago soybean futures. So every minute of every day, the market is deciphering, interpreting, and making decisions based on an array of opinions and ideas. We know that participants in this particular market include commercial participants, which are hedgers, and any type of speculative participants from hedge funds to housewives. We also know that the factors which influence those opinions and decisions vary widely. Production in soybeans and in most agricultural markets used to be the key fundamental driver. Many of us were brought up in an environment where demand growth was pretty steady. Demand growth was largely based on population growth. And the key variable in the market was the size of the crop and what it's doing. But it's interesting, in the last probably 15 years, at least since the mid-2000s, we've all had to learn the harsh reality that we're seeing equal volatility on the demand side, which again adds more complexity to understanding what the drivers are and being prepared for them. Now, if you overlay that with macro events and macro influences, trade wars, politics, and pandemics, it seems to me that we're seeing more and more of those. So whilst unavoidable, they remain unpredictable. And again, we need to be prepared for that. So like it or not, we need to recognise the forces from within and the forces from without that can impact prices. The good news is, of course, that this is manageable. The challenge is knowing when and knowing how. Here we have the chart for US Gulf soybeans representing basis for the last 5 years. The chart shows each of those years in their respective colours on the top lines, and we have the dark blue lines down the bottom, representative of each of those corresponding futures months. You'll notice those months are stepped. That represents the carry in those futures months. So to calculate the basis for these respective years, we're simply measuring the distance between the dark blue futures line and the respective prices. What you can see is that there is a noticeable degree of repeatability. A pattern is formed, which makes basis, specifically in this example, but in most others or in many others, this makes basis tending to be more predictable than futures, or at the very least less unpredictable. This predictability is a function of the fact that the driving forces in basis tend to be those specific to that market, specific to the product, and specific to the place. Physical supply and demand, farmer selling, freight, storage capacity are all examples of those factors, and they're really determining how much and when, in this case, soybeans, need to move to the Gulf. Most of the noise of outside influences reverberates through the futures markets, less so in basis. So whilst the tools are available to manage basis, there are fewer than exists on the futures component. But what's important is that you do have the ability to choose your basis exposure rather than having the risk thrust upon you. So again, you choose as far as the hot potato is concerned. So understanding what those drivers are allows you to make better informed decisions. So you make better choices. So in the theme of remaining practical, I just wanted to highlight this particular chart, which really is making sure that we understand that there is the textbook when it comes to basis and futures in terms of understanding the flat price value or the cash value of a commodity. But being in Southeast Asia, we are a long way from the US Gulf. So typically the further you are away from the market or the origin, typically the basis component will become a greater component of price. Ideally, we would want to make sure that the futures component represents the highest portion, because if it doesn't, we start to suffer from correlation issues and we lose hedge effectiveness. The other interesting feature is that the higher the basis level, the more margin and the more volatility in basis itself there tends to be. So this is actually an opportunity, especially if you can understand the predictable nature and those specific factors which influence that basis. Now, this is not to scale, but like I said, I think that those of us in this region have the ability to capture more opportunity understanding this particular feature. And so this chart is really a reminder of the point that futures and basis can and work independently. So just because futures goes up, it does not mean basis goes up, nor the reverse. In fact, the opposite can often apply, because if you think about futures as being driven by many, many external factors, futures can simply get too low. And when futures get too low, farmers, for example, don't like to sell. So to entice the farmer to sell, the real world, the physical market, needs to pay more to encourage them to do so. And that encouragement manifests itself as basis. So if we move on to stage 2, target acquisition, we're really now starting to understand what it is we want to achieve. So margin protection and margin enhancement are the two general objectives for any risk management process. Often when your customer wants to buy, you don't have it. You haven't produced it yet. And often when you have it, your customer is not ready to buy. So in both instances, the market will often entice you to do one or the other. And carries in futures markets are a good example of that encouragement. Your risk is a function, really, of how much time between these 2 points, between you having to sell it or having sold it and you having to buy it. So to measure this risk, often it's a factor of what prices can do to you and how prices can impact your business in that time period. Futures and basis have a value or provide a value for you to solve for this. And importantly, you get to decide how and when you lock in legs to protect these margins. And flexibility, that flexibility is the key. So having the ability to break out those components of price lets you better value your goods, but also lets you decide when you fix the price. And importantly, this decision can be made irrespective of what your customer's doing. So the next stage then is being able to quantify this risk and our tolerance to this risk. So qualifying the mismatch is reference to that time, the time being the gap between having made a purchase decision or having made the selling decision or being forced to make them, and having that price exposure between those 2 points. Secondly, we need to understand what the circumstances impacting those markets and those prices are and acknowledge those drivers. If we break this down to that volatility of futures and forming an opinion on what we're comfortable accepting as predictable outcomes, which perhaps is accepting the basis movement alone, we can define what is acceptable, which is defining our tolerance. Which brings me to the need to weaponize, which is making sure that we are aware of the tools and have available the tools for us to manage that risk and protect the tolerance that we've established. We need to make sure that we have access to various contracting alternatives, and I mean physical contracting alternatives, access to that futures market, and the tools available to protect that component of the market, whether they be futures or OTC products or options. Also, clearly, you need to have the knowledge of how best to use them. And so with all those tools being determined and the risks identified and your tolerance understood, the next thing we do is develop the strategies using those tools to manage those risks. So I think it's important at this point to reiterate the fact that we're living in a dynamic world. So those strategies need to be flexible, but also I think it's important to recognize in a practical world that you shouldn't have to do things for the sake of doing them. So it's about putting the relevant strategies in place to deal with the specific identified risks and not getting caught up in deploying things for the sake of it. So I'm a big believer in the fact that adding complexity where it's not needed is just that, adding complexity. It's not solving a problem. So at the end of the day, you, like our general here, needs to make sure that you have the tools and the skill set available, having identified the target, to deploy your forces being those tools to deal with the problem. And it doesn't need to be any more complicated than that. And with that, I'll end it today, and thank you very much for your time.